All right, so I'm Heather Pilcher, and this is Brandon, my husband.
Hello, hello.
We're both licensed agents here in Cincinnati suburbs. We're in Ohio and Kentucky, and we are super, super passionate about tax savings and tax advantages as real estate agents because we work our butts off out in the field in the trenches and slaying the dragons, and then we make this money, and the government just wants to eat it all up.
Yeah, they say everyone's biggest expenses, and I think this is exaggerated for small business owners, are taxes. So today, hopefully, we can run through a couple of strategies that everybody can start applying immediately and lower that tax liability.
Yeah, and I'll say too, this class is geared for some of like the newer agents that are starting in the industry, or maybe if you're selling like 10 houses a year, but we also want it to be applicable for everywhere in between up to the teams that are selling hundreds of houses a year. So we're kind of doing about an average between 60 and 90 transactions a year. And so this stuff has been huge for us. We've done some of the strategies for the last couple years, but we just started working with Barbara and her team, your tax coach, this year. And so we've been implementing a lot more, and it's been a huge thing. So we're super excited to have Barbara on here, and we're going to let her pull up her presentation and kind of do an intro. She's amazing, and that's why we brought her on here.
Hello, and thank you so much for having me. I love teaching real estate agents how to save money in taxes because so many of you kind of like fall into this business and don't really think about taxes until there comes a time where you're like, I owe how much? And it really comes as a surprise and is like a huge pain point. So hopefully some of these strategies today can help you before something like that happens. And so we'll just dive right in because we have a lot to cover here. So for those of you that have not met me before or seen us on social media, I'm Barbara, the founder of Your Tax Coach, and we save business owners money in taxes. But it's so much more than that as well. We help people build wealth and generational wealth and become millionaires. And so it's really evolved into a whole brand. We have a podcast, we do business coaching, and we host a big event every year called Minted Wealth Live. So if you hear this and you just want to learn more about taxes, there's like so many free resources out there. You can listen to the podcast, follow along on social media at Your Tax Coach, or if you just look me up on podcasts, I've been on lots and lots of them. I will say before we get started, this is not tax, legal, or financial advice or medical, because I will bring up some cool medical expenses as well. This is just for educational purposes only. So, the first thing I'd love to start with when I'm talking about tax savings is your entity structure. I know that might sound really boring, but the way you're structured really dictates how you're taxed and how much money you're going to pay in taxes. So, hopefully, most of you real estate agents have at least an LLC. But a lot of times I see you don't even have an LLC yet. So, step number one, for sure, make sure you have an LLC. Now, check with your states because you might need a PLLC because of your licenses. It might have to be named a certain way as well. Some companies require it to be your name, LLC or PLLC. So, definitely make sure there and get an attorney for that. But that's for liability purposes. That's in case you're ever sued, which of course we never want that. But being in real estate, it does happen. And I've seen it with a lot of our clients before. And you never know when it's going to happen. So you might as well have your LLC just in place so that you're better protected. Now, what that will do once you have your LLC, it unlocks this really cool tax strategy called an S corporation. It's something you have to apply for with the IRS, but we can apply for you. And it can get rid of 15.3% of your taxes, which is huge. Like every 100K you're bringing in, you can keep 15 more thousand dollars in your pocket. So for agents out there that make 200K, this could save you 30,000. Or for you guys, like you're married, it affects both of you. So that's a double savings right there. So you cannot be an S corporation unless you have your LLC first or your C corporation first. But for most of you out there, you're probably not going to be a C corporation. It's really not beneficial for you unless you were like real as a whole and you want to be a C corp in case you go public or were sold later, something like that. But most real estate agents are going to be an S corporation. And to find out how much you would probably save if you're thinking like, oh gosh, I don't have an entity or I am an LLC, I don't have my S-Corp yet. If you go on your last year's tax return, on your personal return, there's a line on there on your second page of your tax return and it's called other taxes. And I think it's a little sneaky from the IRS because like no one's like, oh, what is this other taxes? But what it really is self-employment tax. And so that's where the S corporation really comes in handy. So huge tax savings there. Also, you're 35 times less likely to be audited when you are an S corporation. So just that alone to me, I have clients become an S corporation from the very beginning. Because a lot of you have probably heard of this and you go back, you ask your accountant, and your accountant's like, oh, you're not ready yet. Oh, like it's only worth it when you hit 100,000 or $200,000. But it's just not true. Like if you brought in 40,000, for example, that's a $6,000 savings in tax. And like, I don't know about you, but I would want 6,000 more dollars in my pocket. Like that's a great family
Yep.
trip to like Disney World or something.
Yep.
So even like don't let them tell you because of like an income amount. But then also, it kind of doesn't matter how much you're making because wouldn't you just want to be better protected from an audit? So S corporations are huge. That's step number one, really, in like saving taxes. Now, when you are an S corp, there's like a couple more rules involved, of course, because the IRS isn't just going to let you save 15 grand and like not have you do anything. Um, the first thing is it needs a separate tax return. So your tax return is now going to be due March 15th instead of April 15th. And the second big requirement is that you have to pay yourself officer's compensation. But this is really cool because let's say your officer's compensation, when we do the study, because you have to do a study to see how much you should pay yourself, let's say it comes back with you need to pay yourself $50,000 a year because you want the number to be low. You want the number as low as possible because you pay tax on that. So you want that number low, but you're like, Barbara, I need like 200K to live every year. Great. You're going to take the other 150,000 as distributions from your company, and distributions are tax free. But here's how you can get that 50,000 of officers comp tax free as well. So when you pay yourself, if you have a retirement plan set up in your company, which I'll go over different plans in a minute, but the first 24,500 of your officer's comp can be completely tax free if you're putting it into your own retirement account. And that counts towards the 50K requirement that you need. Then, if you qualify for an HSA, a health savings account, which I'll go over as well, this year the limit's 8750 for families. So you can get the next 8,750 completely tax-free and it counts towards that 50,000. For those of you with kids, a lot of you out there have lots of kiddos, and I'll go through some kid strategies too. But another really cool one is if you have kids that are in daycare, so probably like kids under 5, but also if you have kids in before school care or after school care, so like this could be a sixth grader and they're going to after school care. You can put it into an FSA, which is a flexible spending account for dependents, and this year it's 7,500. Meaning you can pay for before school care, after school care, summer camps, anything for your kids tax free. This is all pre-tax. The only thing that doesn't count are overnight camps. So if you send your kid overnight somewhere, those don't count. But that 7,500 also counts towards your $50,000 requirement. And then hopefully you're going to take 7,500 of it and put it into a Roth account. Roths are really where you build your wealth because they're tax free when you take them out later. And so the limit this year is 7,500. So you could put 7,500 of your officer's comp towards it as well. So you just hit 48,000, pretty close to your 50K. So you're going to be taxed on just about $9,000 of your 50K salary, but that's maybe like $1,000. So you're paying $1,000 in tax rather than like $15,000 in tax if you didn't do any of these. So there's also ways to get your officer's comp tax free. Now I have to go into documentation before we get into some really fun deductions because it's really key. I'm going to go through like travel deductions and meals and your family and your kids and all these things. But first things first, you have to be keeping receipts. And yes, they need to be receipts that look like this. They're itemized. We can see what you purchased. Your bank statements do not count, and your credit card statements do not count because when the IRS sees like $400 at Mastro's, they need to see who purchased what and how many people were there. So you have to keep the itemized receipts. Now you can scan them in electronically. You don't have to keep that crazy weird paper that the ink disappears. So you should scan them in because the ink does disappear. And if you're in Arizona where it's really hot, if you leave your receipts in your car, the ink disappears in like a day. So be really careful with your receipts. Scan them in as quick as you can somewhere electronically. Maybe you use QuickBooks and they have a receipt tracker, but there's also just receipt tracker apps. Some people just have it in their photos in their phone. Like whatever will get you to just take a picture of it works just fine. But have the itemized receipts. Then you need documentation. So if you are taking trips, you need a travel log, and I'll give you an example in just a minute. If you are having a board meeting, you need to have board meeting minutes. So all the documentation that you can is really key, just in case you were audited in like 7 years. You're not going to remember what happened in January of 2026. So document it as you go. And then the other thing that's really key is separating your business and personal. And I know that as real estate agents, it's like, well, Barbara, my whole life is my business and I'm always working. Um, but you really have to think like, when you're buying something, is this personal or is this business? And put it on the right card. Okay, so if you are out to eat, can you tie it to business? And is there a business purpose for it? If so, put it on your business card. Because as much as you can, you don't want to go back later and be like, oh, I have like $2,000 worth of meals that I put on my personal card that I then need to add to the books. Because the IRS does not like something called commingling, which means mixing business and personal. So be really diligent about your cards. Even like, I know it's really easy these days to like tap our phone, have a business card and personal card on your Apple Pay so that you can use the right card when you're out and about.
Yeah, Barbara, just kind of piggybacking on what you're saying there, I had it explained to me a long time ago, really well, that helped is we have to start viewing our businesses as like another human, like another projection of ourselves. Like I have a social security number, I am an entity in the eyes of the IRS. So does
Yeah.
Heather, and so does our business with the EIN. So this
Mhm.
is a completely different, almost being, and that
Yeah.
being needs their own bank account, their own debit cards, their own credit cards, their own credit history.
Yeah.
And when we go in and spend money, like having it come out of those accounts separately and really separating them as much as you can. Like for us, we use QuickBooks Online. It just seems to be really, it works for us really well. And we
Hmm.
have a QuickBooks Online for us personally, and we have a QuickBooks Online for our business. We don't
Great.
have our business and personal in the same financial tracker.
Yeah.
And it just really helps that mindset of we have to separate these out and make sure we're showing, like you said, that paper trail and justifying the fact that this is the business acting, this is not Brandon acting.
I love that. Treat it as another human. Yeah, like treat it with respect. Keep the documentation, keep all the proper paperwork. And I love that you keep separate books for personal as well. I think it's a great way to not only like see where your money is going, but you can also like see how your net worth is building, which is really fun. So definitely separate those out for sure. Because I've seen as well from the IRS, like typically when you're like quote unquote audited, the first thing they're going to do is send you a letter. And it's really usually just a clarifying question, like, show me your travel documentation or receipts. And one, if you don't have receipts, they're like, Wahaha, we're going to ask for more things like show us your meals receipts, show us your car receipts. And if you give them an account and everything's mixed up, they're also going to keep digging in. So it's like as much as you can, you want to have things like clear and precise so that when they do ask a question, you can very easily answer it and they'll go away.
Yep.
Yeah, we want them to go away. Not to scare people. I mean, the audit risk is like less than 1%. So it's very, very low and it keeps getting lower actually in like the last 8 years. Every year it keeps getting low. So the audit percentage right now is like 0.4 of 1%, which is fairly low. And for our firm, for example, we've filed like 9,000 tax returns in the last 5 years, and we've only ever had one audit. Now, people get letters all the time, clarifying questions, but an actual audit, only one. So one out of 9,000, the rates are pretty low. They're also less likely to audit you the more professional of a firm you have because they know that they're going to lose most likely to the tax professional going against an IRS agent. So just some like fun tips there.
Definitely.
Okay, one of my favorite deductions out there. And hopefully you're watching this on your computer and you can like take a picture with your phone for this travel guide. But you can download my travel guide. It'll show you how to deduct any trip that you're taking. So now you're never going to take vacations. They're all going to be business trips and they can all be business deductible. And in my travel guide, I even show you how I wrote off like a 3 week trip to Paris or all of France, really. So definitely download that travel guide. But I'll give you the IRS rules for travel and you can kind of apply it to your own trips coming up this year. So, for domestic trips within the US, you need 50% of the days to be business related. So if you were going on a 7 day trip to Florida, you would need 4 out of the 7 days to be business related. So the cool thing is, once you say I'm going on a business trip, the IRS gives you the travel days as business days. So obviously, you're probably going to fly to Florida. So first day is business, and you're going to fly home at the end. So the last day is business. So you only need 2 days in between. That's business related. So maybe you have a board meeting, which by the way, every entity should have a board, and you have to at least have an annual board meeting. This is usually a state requirement. And if it's not required by your state, if you were ever sued, the first thing the other party is going to ask for are your annual board meeting minutes because it legitimizes you as a business. And if you don't have it, they'll sue you personally because they'll say, oh, I can pierce the corporate veil. So it's just like a liability protection thing. Have a board. You can be the only person on your board. That's totally fine. But like for me, I have my husband, my kids, and my best friend on my board. So that way, whenever we travel, we have board meetings and it can all be a deduction. So have like people you love and want to hang out with on your board. So maybe one of the days is a board meeting, and then one of the days it's beautiful in Florida, so you have a photo shoot, and you can put that on your website, on your business cards, or maybe for you, you're researching a new market for real estate. Maybe you want to start investing there or have investor clients that could buy in that market. So make sure you document, the houses you're looking at and the other agents you're talking to. But very easy to get that 4 days out of 7 days rule so that the whole thing is a write-off. For international travel, it's a little harder, but that makes sense because the IRS wants you to prove, a reason and a good reason why you're going abroad and writing it off in your business. So 75% of the days need to be business related. So let's say a 10-day trip to Italy, you need 8 of the 10 days to be business related. Again, the day there and the day back automatically count. Or like pro tip, I always take a red eye, so then 2 days really count as business because I'm
Smart.
traveling for 2 of those days. Um, so 8 of those 10 days. But again, same thing. You can have photo shoots, board meetings. We have a lot of clients in other countries, so I'll typically plan a meeting with them when I'm abroad. Maybe there's a conference somewhere or a retreat in another country, or there's a lot of continuing education in other countries as well. And so you can pretty easily get to that 8 out of 10 day if it's a 10-day trip. Another cool rule that I like from the IRS is if it's a 7 day or less trip internationally, only one day has to be business. So a lot of our clients use this for trips to like Mexico because it's very quick and easy to get to. And as long as the trip's less than 7 days, only one day needs to be business. So you have a board meeting one day for like 4 hours and the whole, trip to Mexico is a deduction.
Yeah, that's amazing.
One of my other like favorite things to deduct in the business are meals. And similarly for me, like anyone can be a tax client because everyone needs a tax return. Same for you as real estate agents, like anyone can be a client of yours. Everyone at some point is probably going to buy a house, sell a house, knows someone that needs to sell a house at some point. And so whenever you're going out to eat, you can somehow tie it to business as long as you planned it beforehand and you talk about something business related when you're there. And I don't know about you, but like even when I'm out to dinner with like my best girlfriends, I always end up talking about business. And then they start talking about their business. Or then we're like, what's working for you in marketing? Or, man, the algorithm sucks on social media. Like, why isn't my stuff getting pushed out more? You always end up talking about it. So put it on your calendar ahead of time because you know it's going to happen. And then you can write it off as a business meal. So this could be with clients directly. This could be with potential clients. This could be with vendors that you work with, maybe like loan officers you partner with, or title companies. This could be for marketing purposes. A lot of times, we have a lot of real estate agent clients that do a lot of things in their communities. So I'm thinking of my friend Lindsay here in town, and she works with like the Scottsdale magazine. And so whenever there's a new restaurant opening, she's going there and she's like taking cool content and she makes a little reel out of it and she tags the new restaurant. And she's a real estate agent in Scottsdale, so it is going to help her in her business. But she just got to write off like a bougie dinner. So if it's for content, that works as well. You don't have to be with someone else there. And networking, I mean, you can network with anyone, anywhere. So I say typically like 90% of the time you're going out to eat, you can probably find and tie it to business in some way, shape, or form. Now, here is probably the most commonly missed deduction or miscalculated deduction out there, and that's your home office deduction. I still hear from a lot of people like, oh, isn't that a red flag to take a home office deduction? And like, it was a red flag in like 1999 when nobody worked from home and people's computers were like the size of your guest room. But now everybody works from home and everybody has a home office. And so, really find like a designated space in your home that you can call your home office. This can't be somewhere that's like a guest room that's also your home office because then it's mixed use. So really have a designated place for it. But when you do have that, there's so many things you can write off. And so you can write off your mortgage interest, not the principal payments, but the interest, HOAs, property taxes, insurance, every single utility that you have for your house. Maybe you have a landscaper or a pool person, or probably a lot of you have cleaning people, like anything you're spending money for your house, you get to take a percentage of that. Now, what's the percentage? I'll get into that in a second, but your accountant is probably taking what's called the simplified method. And the simplified method caps you out at 1,500 bucks a year. Which, okay, cool, you're getting a $1,500 deduction, but like that's not too sexy to me. Where you get the big deduction is when you calculate the actual method, and that's what we do. And that is where you're taking all these expenses because there's no cap on that. So most of our clients are getting like $5,000, $10,000 in deductions, which is way better than 1,500. So don't let your accountant kind of like take a shortcut because it's way easier to just do simplified. I'll say like home office calcs are probably one of the things that take the longest when we are preparing tax returns, but it does save people a lot of money. So your percentage, the percentage is based on square footage that you use for business versus your whole house square footage. So let's say you have like 150 square feet out of 1,500 square feet of your whole house. That's 10%. So then you would take 10% of all those things that I mentioned before, but try to increase the percentage. So how do you do that? Pick a room that has like an ensuite bathroom. That'll increase your percentage. So you only use that bathroom for business. So now maybe you're at 200 or 250 square feet for business. But also, probably most of you have for sale signs in your garage or, staging materials or
Open house
gift
kits,
baskets. Say that again.
open house kits, all the
Yeah,
things.
open house kits. It's storing your business vehicle. So add your garage square footage as well. Or if you have like a separate storage or a hallway closet that has business stuff, whatever it is, as much square footage as you can add, the better. And probably like a really highly missed deduction as well is I love when you can build another dwelling and that's your office. So it's really common in California. They call them ADUs, or in Arizona, it's casitas. It's kind of like called something different all over the US. But when you can build another dwelling, that entire dwelling you could write off. So the cost of building that, if it's for business. And what's cool is like maybe you retire from real estate in like 5 years, 10 years, 20 years, whatever it is. Your business just paid for that dwelling, but then you retire and it increased your home value. Basically, you just got like a business deduction for something that's no longer used for business after you retire, and you get to reap the benefits of it. So build it while you have a business. I always like to touch on vehicles with real estate agents because I know you're in your cars all the time.
All the time.
And 2025 became the best year ever to buy a vehicle, but it also applies to 2026 moving forward because this was made permanent. So prior to 25, you can only take a percentage of the cost of the vehicle that you purchased if it was over 6,000 pounds. And now 2025 forward, you can take 100%. So let's say you buy a car over 6,000 pounds. So maybe something like an Escalade or a Yukon or a Denali, or I think those are the same things. Um, I'm not so good with cars. Some of the Range Rovers count, not all of them. Anything sport probably doesn't count, but any of the bigger SUVs will. G-Wagons, um, the Lamborghini Urus. Porsches used to count, and now Porsche made them 5,900 pounds, which I think is so silly
Dirty.
for taxes. But Tesla made two of their cars 6,001 pound on purpose because Elon was like, screw the IRS. But um, find a business vehicle over 6,000 pounds, and then you can take 100% of it this year. So let's say you buy $100,000 Escalade and you finance it like most people do. So maybe you're only paying like $1,000 a month, $2,000 a month, but you get to take $100,000 deduction in the year that you buy it, or whatever the cost of the car was. G-Wagons are like 250K. So you would be able to take a $250,000 deduction. But most of you are probably taking mileage, which is like such a disservice because yes, you drive a lot and you're putting a lot of miles on your car, but like even at 20,000 miles a year that are business related, you're only getting like $13,000 in deductions. Whereas like cars are so expensive now, like even a Honda Civic is like 50 grand. Um, so take the actual cost of your cars. Don't let your accountant take mileage because then not only are you taking the cost of your car, you now get to take gas and repairs and maintenance and insurance and registration fees, everything related to your car. So really taking the actual is so much better. Okay, we have to talk about retirement, which some of you might be like, ugh. But for so many of you, you're not taking care of your own future because you're so busy working. But I promise you, they're so easy to set up and it will save you tens of thousands of dollars in taxes. So for most of you, you can probably qualify for a solo 401k because you don't have a full-time employee in your business. Contractors don't count. So full-time employees that have been with you more than a year, that spouses and kids don't count. So for most of you, it's going to be solo 401k, which is great news because they're my favorite for small businesses. And this year, you get to take up to $72,000 as a deduction, and all of that's going into your own retirement account. So your money is not going anywhere. It's staying with you instead of going to the IRS, and it's going into this investment account that you'll get to um, take later in retirement. Now, what if you need the money before retirement? Why I like solos is because you can borrow against them. And when you borrow against them, the interest you pay just goes back into your own retirement account. You're not paying a bank interest, you're paying yourself interest, which is really cool. So please, please, please set up retirement accounts this year and don't let your financial advisor let you set up a SEP. That tells me that they're lazy and they're not looking out for you. So for those of you out there that have a SEP, it's a huge red flag and I'm not a financial planner, so I'm not setting these up for you, but I can refer you to some really great financial planners. Something else we love to do with our real estate agent clients is involve your family in your business. One way is with a spouse if you're married, and there's three ways to do that. They could be a part owner, a part employee, or just a board member. And there's pros and cons to each. So it's really important to know really like what's your goal of having your spouse in your business. Best case scenario, I think, is part owner because now you can do everything together and it's a write-off. You can have two business vehicles. I mean, you could have 10, it doesn't matter. There's no limit, but you each can have business vehicles. You can each have retirement accounts and max them out, and they're the best for owners. You can travel together, so many things. But for some people, they're kind of like, I don't want my spouse to have part of my business. So maybe then they're just an employee, but then there's some things you can't do. And then for some people, they're like, I don't want them as an employee either. We're just going to add them to the board. But then your only perk really is like having board meetings in cool places. So you can still deduct all the travel, but you're not going to have really any other business expenses related to that. But adding spouses in is a huge strategy and can save you so much.
I think too, they
Yep.
don't have to be a real estate agent, right? And I think a lot of people are like, I don't want to have to deal with the licensing and all of the dues and everything, but they can just be an employee that is an assist, in an assistant kind of a role.
Yeah, exactly. They don't have to be a part owner. Some states won't let you have non-real estate agent client or owners in a real estate business, but most states will let you. And at least, 5% or something like that. They just have to be something above 2% to get all the tax benefits, but very few states won't allow it. But also you could get around it by just having them be an employee.
Awesome.
We also love kiddos on payroll because the IRS gives you $16,100 this year tax free. So in 2026, if you're listening to this in 26, the numbers change every year, but they usually typically only go up. So this year is 16,100. You pay them tax free. It's a $16,100 deduction in your business. And then that money that your kid gets, you're just going to be spending it on stuff you're already spending money on for them, their clothes, their toys, their private school, their travel sports, whatever it is. Kids are expensive. I'm sure you'll find a way to spend it on them. But ideally, out of that 16,000, you're going to take 7,500 of it and max out their Roth IRA because now they're going to have a W-2 and Roths are only really for people with earned income, which now they will have. So you can put 7,500 away. And I'll show you a calculation in a minute, but you can make them tax-free millionaires so easily. One calculation said if you have a kiddo like at 13 that you started on payroll and you just maxed that out for them till they were 18 and then they continued that, they'd have over $2 million completely tax-free later on in life. So paying your kids is huge. And you're like, what can they really do in my real estate business? Here are some things. But a lot of our real estate agents have them stuff envelopes. When you're like trying to send out letters for like, we're looking for this house, or I have a buyer, I have a seller, your kids can do that. And they love helping. They could take photos, videos. We've had clients have their kids do like listing tours. I mean, obviously the agent's going to do like a professional one as well, but like for social media, I think it's so cute when kids walk through and they're like, and this is my favorite thing about the house, which is something like as an adult we wouldn't have even thought of. So your kids can be on social media, they can knock on doors, they can help you put the for sale signs up, so many different things, and you can pay them for that tax free. Here's one calculation. If you have babies, because you might be like, well, they can't stuff envelopes yet. Well, they can be models in your social media. And so if you started them at like age 0 with that 7,500 a year, they would have $6.8 million in their retirement account. And again, this is completely tax free.
Big generational wealth move for sure.
Yeah, we're all about generational wealth here. Something that changed in 2025, which is so exciting, is that you can start writing off gym memberships and a lot of health and wellness deductions if you have what's called a medical expense reimbursement plan. Now, these are like a bit complicated to set up. It's really not something you can do yourself. So, highly recommend having like a tax strategy company do it for you or a third party administrator. But once you have it set up, and it will depend on the structure of your company as well as to how we set it up because S Corps are different than C Corps, which are different than sole props, which are different than partnerships. So it all depends. But once it's set up, now you can write off things like saunas, cold plunges, supplements that you take, talk therapy, a therapy animal, and like I said, gym memberships, Pilates, personal training, anything like that. So it can like really add up. So I have a whole guide on it because it is a bit more complicated. So definitely scan that QR code and you can download my free guide all about medical expense reimbursement plans. And then just because everyone always asks, they're like, oh my gosh, I'm learning so much from you, but like, what is it that you actually do? We help business owners save money in taxes. So we'll create your tax strategy plan, just like we've done for the Pilchers. And we also will do tax preparation. So if you just need a tax return prepared, full service bookkeeping. For those of you agents that have investment properties or investor clients, you should definitely know a ton about cost segregation studies because they're like the biggest way to save money in taxes ever, but they're for investment properties. And I have a whole master class on cost segs, so you can look that up on my website. But we do those in-house. You can only do it with a CPA firm or engineering firm. We do a lot of courses, webinars, and we host events and retreats as well. So if you're wondering what we do and how you can now switch accountants because you're like, man, my accountant's not doing any of this stuff, you can scan and schedule a call with us. And then I think this QR code might take you to our next free masterclass, which is at the end of February. But if it's past February when you're watching this, I'm sure there's a next masterclass on there somewhere. And here's just how you can find us. But I'm sure, Heather, you have some questions for me.
Yeah, I think we both have lots of
Yeah,
thoughts.
that was fantastic, Barbara.
Yeah.
And just to kind of add to what we've been able to work through with you and your team, is this can be especially if you're starting from ground from the first floor. This can be a bit of a daunting task. We've had a couple of our friends that have worked with you confirm as well that like it can seem a little bit like you're back in a college course.
It's like a
It's
Yeah.
like
semester
a semester
project.
project as far as just making sure you're all set up. But once you're set up, and if you start doing the math, if you're going to spend 20, 30, 40 hours kind of getting the foundation set up and getting things in the right order, look at how much you're going to save in that amount of time and add that to at least mentally what you're earning this year. If you can write off $100,000 or $150,000 in deductions, which is
Mhm.
feasible, then you're saving yourself all that money, which a penny saved is a penny earned. So
Mhm.
your the courses, the templates, the guidance, the Q&As, very, very helpful in making sure we're doing this right because the goal is to keep the IRS rules and also pay as little tax as we must.
Yes.
Definitely.
Yeah.
I think too. So, when we first started as agents, I think it was like year two, we heard someone say, like, you really need an S Corp. And it was like, okay, why? I get like, quote, legal protection. But like the part that was most interesting to us was like the financial savings because those are very direct dollars. And so for us, if we have our oldest kiddo in a private school and that's $5,000 a year, like you said, if you can even just save $5,000 in taxes alone, that's huge. And
Yeah.
like, so for us in the last, 6 months opening up, and this is like a whole nother can of worms, like Barbara has tons of resources, right? But having a family management company where our kids are the employees, it's been amazing to be able to transfer a lot of the expenses that we were already paying for to come out pre-tax, like Barbara was
Yeah.
talking about, or tax-free. And so if we have two kids, we can pay them pre-tax or tax-free, then 30,000 plus dollars of what we were already spending on them goes a long way. And
Yeah.
so for real estate agents, I just think that like real estate agents work too hard and they're helping people with the biggest transactions of their life. And it's so important to make time to tackle some of this stuff, get it set up, and then it's a lot easier to maintain it once it's up and running. But, I think that so many CPAs or accountants just don't want to even learn about this stuff. And so it really is super important to be aware of what's out there and then make sure you get professional help to do it right. So, a couple of really quick questions, Barbara. I think when we were talking about vehicles, so if someone can buy or owns a vehicle that's a 6,000 pound, then they can leverage that strategy that you talked about. But what advice would you give to maybe agents that they're like paycheck to paycheck, they can't afford to go buy a bigger or a brand new vehicle, they have to keep what they have? How would you attack some of the vehicle expenses for those agents?
So, new agent, they already have a vehicle, they're not buying a new one. You can contribute a vehicle to your business. And the same is true for home office stuff. So, like, if you started your business and you probably already had a laptop somewhere, you already had a desk,
Mm-hmm.
like kind of all the basic stuffs we all have, you can contribute the cost of that stuff, whatever it cost you at the time you bought it, into the business and take that as a deduction too. So, the same is true for cars. So, maybe you already had a $30,000 used Forerunner. That's totally fine. It can be used cars. You used to not be able to use used cars, but now you can. So, yeah, you contribute the vehicle to the business, start writing it off that way. The only hiccup you might have is if you have taken mileage at all on a vehicle, you cannot ever switch it to the actual costs. So that's a bummer for those of you that have had accountants that had you take mileage. Really, the best bet is like get rid of that car and buy a new one so
Mm-hmm.
that you can start taking actual. But if you haven't taken mileage on that car yet, you can contribute it and write it off that way.
Yeah. So I think there probably are a lot of agents. Again, they've just been like hustling and bustling, worrying about selling houses and haven't even been writing off mileage. So there's a lot of different ways to implement some of these strategies. Um,
Yeah.
Yeah, one other kind of big write-off that we've been really focused on and been able to benefit from is the Augusta Rule, 280A. So being able to rent your house to your business effectively and use
Yeah.
those as instead of distributions, use those as reimbursements. Can
Mhm.
you share just a quick overview of that and how that can apply to these our agents?
Yeah, first of all, kudos to you for just spitting out an internal revenue code there. Um, Impressive, but yes, the Augusta rule is really cool. It started in Augusta, Georgia, which is why it's called that way. But there is an internal revenue code for it. But it started for the Masters Golf Tournament in the 70s before like Airbnb was obviously around. And so when the tournament would come to town, every hotel would sell out. There'd be nowhere to stay. So these wealthy mansion owners would be like, well, why don't I get out of town? Because I don't like everyone here in my town anyway. So I'm going to leave. I'm going to rent out my house while the tournament's here. And they had a lot of money, which in turn meant really good lobbyists that they got a law passed that said if you rent your house out for 14 days or less per year, then you don't have to claim any of that as income. So then that expanded to like, oh, when the Super Bowl's in my town or the Olympics or big events like that. And then it turned into business owners. Well, why can't my business rent out my house for 14 days or less per year? And the money paid to me from my business is now tax free as long as it's 14 days or less. So it's a great strategy. We have clients that can get so much money out of their business tax free, and also, the IRS will knock it down so fast if you don't have all the documentation. So you have to have lease agreements and you have to have invoices, and the money has to actually move. And you need to have like comps, that like look like your house and for the reason that you're renting it out so that you can justify the price behind it. And so there is a lot of like noise about it on social media, but you have to really document it correctly.
yeah.
Yeah.
And assuming that you do it correctly, it really does go a long ways.
Yeah, and a
Yeah,
lot
it's
of us are already
huge.
Yeah.
doing these meetings. We're talking about our 2026 goals or we're reviewing our quarterly financial progress. So if we
Yep.
can be in the works of what we're already doing and benefit from them, these are great strategies to be implementing.
Yeah.
We have in our home here, we have our little podcast studio that's dedicated to podcasts. We've got a conference room, a private office, And so if we were to go rent something like a podcast studio here locally, we've got a couple of quotes from what it would cost us to do this somewhere else, and then we can take the average of those or whatever is appropriate and
Yeah,
apply it to this Augusta rule. And again, we're doing the same thing. We're just benefiting from it from a tax perspective.
I love it.
That's great. Well, so I'll just put in one more plug. There's tons of free resources here that Barbara put QR codes on. Go download those because they'll spark so many ideas for you to implement in your business. And then also like go listen to the podcast and get some ideas, and go follow her on social media. And then Brandon and I are both on Instagram. We'll put our information in the resources here too. And anyway, I just want to say thank you so much for joining everybody today. And thank you, Barbara, so much.
Thanks for having me.
Thank you.
All right, we can go edit this back. You want to turn off the recording real quick?
Yeah.
Well, thank you so much for